Hi, my name is Jade, co-founder of Legendary Real Estate Services, and in this video I'm going to share why we're not in a recession yet. There will be one, but it's natural. It's part of a normal 18 to 20 year real estate cycle. However, we're not quite there yet. So I'm going to show you why that is, and I'm going to show you some things to look out for so that you know when it's on the horizon so that you can make the best decision for you, your family, and your real estate portfolio. All right. So let's dive in. Let's start with why we aren't in a housing recession. The first reason is because we have a very low inventory of homes for sale. That wasn't quite the case in 2006, 7, and 8. What had happened was that the market was flooded with builders overbuilding. And plus, with all the foreclosures that hit the market, not only did we have brand new buildings, but we had a huge influx of inventory of foreclosures for sale. Those two combined put us in what's called a hyper supply phase of the real estate cycle. What happens when supply goes up? Demand goes down. What happens when demand goes down? Well, so do prices. In order to get to the recession stage, we first have to have hypersupply, and we do not have hypersupply in the southeast Wisconsin area when it comes to single-family homes or those residential units. We also have a very strong, robust lending mortgage industry right now. In the housing crisis 2008, what had happened was there's a lot of subprime lending going on. People who weren't qualified to have a particular loan, they were getting these loans, and when their adjustable rate mortgage adjusted with interest rates, they couldn't refinance their homes. We don't have that subprime lending right now, so right now we have a very solid lending mortgage industry. Next, we have an enormous amount of equity in our homes as compared to the last time. This is from Adam data, and what they're doing is they're tracking the year-over-year equity or the sales gains and return on investment. What they found, median homes sold last year, the average profit was about $100,000 or a 60% return on investment. When we do have a recession, homes drop 5, 10, 15, or 20%. On average, the homeowners have that equity to withstand it and weather that storm. That's something we didn't have during the housing crisis in 2008. What we had in 2008 was an incredible amount of foreclosures due to that subprime lending that I spoke about. We had hit a peak of about 3.6% foreclosure rate. Now we're sub 1%. More specifically, this is a graph done by CoreLogic back in November. The foreclosure rates right now, it's at 0.3%. Those are some historic lows. In fact, what their study found was our delinquency rate as a nation has receded for the 20th consecutive month as of December. We are strong in that area, and that's another reason why when there is a recession, it's not going to be that bad. Now, supply. That was a huge issue. As I mentioned, we had that hypersupply. We don't have that hypersupply. In fact, we have about 2 months of inventory. So what that means is if no home came on the market to be sold, how long would it take for the available demand to absorb the available inventory? And right now, it would just take 2 months. Anything below 4 months is a seller's market. Anything between 4 to 6 is a balanced market. Anything above 6% is a buyer's market. As you can see, we're nowhere near a buyer's market, and we haven't been for a couple of years now. In Kenosha County, they have even less inventory than we do. Because there's low supply, we're not going to see a huge shift in home prices. That's not going to dramatically drop until we have an influx of supply. Not to say that it'll never happen. There's a subdivision that's in the final phases in Lake Geneva that's set to complete 85 dwelling units. In the Burlington area, 286 homes, 60 apartments. That's a lot of supply. But they're still in the talking phases, the approval. They haven't even broken ground yet. They still got to do the acquisitions, the financing, the land development, and then the vertical development. This is on the horizon, but this is not a today or this year problem. Same thing in Waterford. They're looking at annexing some land. That's going to take some time, but I want to make you aware of what is on our horizon. Last year in 2022, in a study of the major metropolitan areas, we had 420,000 apartment units hitting the market. That's a lot of units, and a little bit more in the year prior. Just to give you a scope of how dramatic that is, we haven't had that many housing units flood our market in almost 50 years. Multifamily homes, there's a lot of them in these major metropolitan areas. And what happens when there is an increase in supply? There's going to be a decrease in demand because the demand is going to absorb it. What I mean by this is downward pressure on rent prices because there's so many, and with housing prices appreciating as high as they did and with interest rate hikes, it's pushing up the cost of owning and pushing down the cost of renting. So we have these two conflicting forces. In a lot of metropolitan areas are seeing deliveries of these build outs. They're probably right now in the hypersupply area. Just to give you an idea of where that is, these are some of the metropolitan areas that were surveyed. Rent Cafe in Chicago is one of them. They had about 8,500 units hitting the market. So it still remains to be seen what's that going to do to single family home and downward pressure on prices. This is from Realtor.com. Nationwide, across the board, in 45 of the largest metro areas, it's actually now cheaper to rent than it is to buy a single family home. That's something you're going to see that's going to not jive with the supply-demand ratio that I'm showing you from the Metro Multiple Listing Service. The amount of interest rate now that we're having, that is not the issue. This graph starts at about 1970 all the way to 2022. They were lucky if they had about 7% interest rates between 1970 to about 2010. Our economy has thrived since 1970s. High interest rates, while they're not fun, they're not an issue. It's a normal part of our American history and tapestry. The issue that we're contending with right now is the rate of the hike. The interest rate hike that the Fed started last year, it's the fastest that it's been in the past 30 years, which is what gave us our huge sticker shock from being at record low. The dramatic difference in what we could afford in 2020, 2021 versus what you could afford in 2022. So that is the real issue. Volatility, not the actual interest rates. As of this morning though, the Feds met and they did hike interest rate 0.25%. The good news about it is that it's the smallest rate hike since they started, meaning they were decelerating their rate hike. So they must have a little bit of confidence that they're getting inflation under control. This is a bullish, strong move in the right direction to rekindling demand. Days on market. So if a home gets listed today, how long does it take before it gets under contract? So as you can see, it's been hiking. There's that upward trend that's been corresponding with the interest rate hikes, and it hit an all-time high in December, but that was to be expected. One, normal seasonality. Demand tends to decrease when it gets cold and around the holidays. Plus, with affordability being an issue, interest rates, this wasn't unexpected. It was dramatic, but not unexpected. It's December, so probably it'll come down about 50, 60. Boom, it came right back into that range. So let's watch it to make sure it stays in that area. Kenosha, they're seeing the same thing, that same gradual increase. So we'll watch that too to make sure that that stays, around the 50, 60 level, which is about right, especially with still being the winter markets. From a days on market standpoint, interest rate volatility, that's a risk for buyers, sellers, and builders. And because of that, homes are going to stay on the market much longer. When to really start worrying is when you have high interest rate and interest rate volatility, long days on market, and then an influx of supply. And that's going to be a cocktail that I do not want to be anywhere near. If it happens, it happens. It's not going to be fun, but that's what you want to really look out for. This is good news from that interest rate standpoint. So we hit a peak of 7.8%, but now we're down to about 6.15% in January. And you can see in January a huge uptick in mortgage purchase interest rates all the way back to, I think, pre-September, October levels. I'm excited about that because that means we've got buyers that were on the sidelines probably during the holiday season that are wanting to get back in the market. They're seeing lower interest rates and now they're getting back excited. So this is a really good sign that we may have a very strong, robust spring market. So that's why you see that exclamation mark. You see that question mark because my crystal ball from Amazon is still on back order. I'm not sure what's going to happen next year, but we'll keep an eye on that. In the local news, I saw this headline and I just did a double take. Homeowners looking to sell might be missing a windfall. Not quite. The median sold prices from last year, they saw about a 60% return on investment or about $100,000 in equity. So homeowners are still poised to profit from a decade-long growth in equity from home appreciation. We've got a home that we listed not too long ago. As soon as it hit the market, we had a bunch of showings and it was under contract in about a week. And there was multiple showings, multiple offers. The offer that was accepted was over asking price. Are they missing out on a windfall? No, it depends. If you've got a great home, well-maintained, in a good area, and you price it competitively, you're probably gonna get your asking price or above. On the contrast side, we had another home listed. It was a little bit older, had some issues when we had home inspections, some electrical issues, some plumbing issues. Did they miss a windfall? Maybe, because if they sold it during really that market frenzy, maybe the buyer would have waived inspections, which we would never recommend doing ever, unless that's your industry and you know how to do it and you have the cash to do it and you're comfortable with it and you've been disclosed everything. Homes sitting in the market longer as monthly sales decline. Well, of course homes are going to sit in the market longer. It's a holiday season. That's what happens. It's normal seasonality, but it's not necessarily a bad thing because you saw the rebound in the graphs that I showed you. This is not monthly home sale price. This is the amount of homes sold declining. But again, we're in a seller's market and you saw how tight our inventory is. Of course, sales is declining. It's true, but it's not as bad as it seems once you wrap a bit of context around it. Kind of takes the pizzazz out of the headline. During the 2020-2021 time frame and early 2022, you saw the sold to list ratio above 100%. Say you list a home for $100,000. If you sell it for say 105 or anything above 100,000, your sold to list ratio is going to be above 100%. Conversely, if you sell it for less, it's going to be below. Or 2020, 2021, it was way above it because homes were selling over asking price. But as soon as the interest rate hike started, buyers really put the brakes on that aggressive buying. So you're starting to see that decline. It corresponds with the interest rates as home buyers sort of got a wake-up call that, they need to really look and evaluate their budget on what they want to spend. A lot of it too is probably psychological in the sense that sellers that are selling today, they saw their neighbors or family or friends get this windfall and they don't want to miss out, so they price it higher, but they are not adjusting their mindset to, okay, I'm going to have to price this competitively and fairly. This doesn't mean below what it's worth, fair market value based on comparables. If you have a good, well-maintained home, you're good to go. If you have a lot of work that has to be done, like maybe you need a new roof or new plumbing or something, you're gonna have to price that into the home. If you do, you're likely gonna sell for right around what you originally listed for. If you don't, well, then you're gonna have price reductions, and that's what this sale to list ratio decline is. Came back up, it's a good positive sign. Sellers may have to make concessions if there's some work that needs to be done to their home, especially if it's a material adverse defect. It's going to affect either the value of the structure or the health and safety of the homeowners or tenants. So something to be aware of. Kenosha is about the same way too. There's still a lot of equity in our market, record amounts of equity and return on investment for homeowners. Big picture takeaway, I already covered the first one, recessions. We have little to no supply, as I showed you. We have a strong lending market. We have double-digit gains. We have record low delinquency rates. The thing to really watch out for is inflation, interest rate volatility, and inventory, especially inventory. Keep an eye on it. Because of that interest rate volatility, homes are just going to stay on market a lot longer. Sellers, you're going to have to be aware of that. Adjust your plans accordingly to that. If you price your home fair market value, price it competitively, then you're likely not to have a lot of days on market, and you're probably going to sell close to your original list price. And we're not going to see a huge drop until we see that supply. There are plans, but those plans are maybe about 1 or 2 or maybe more years out. And that's going to get pushed out again because of that volatility, that uncertainty with interest rates. So I covered a lot. If you have any questions, there is my contact, my email, our office number, or if you would like to subscribe to our newsletter and get these videos and some of the articles, then go to our website, click contact us and send us a message. And last but not least, if you know someone who is looking to buy or sell a home in Southeast Wisconsin, including Walworth, Western Kenosha County, give us a call, send us an email, and then we hope to see you on our next one. All right, have a great day. Thanks for stopping by.